In this video, we're really going to start talking about managerial accounting. That is the decision making inside the company that pertains to operations. Primarily, we'll be talking about production questions, right? How do you predict labor needed, materials needed? How do you determine what price is appropriate, right? So we're going to start this process talking about something called cost volume profit. So essentially, we're going to start with what's referred to as cost behavior analysis. This basically just says that there is a relationship between specific costs and changes in the level of business activity. Some costs change. We're going to refer to those as some variable costs, and other costs remain the same, fixed costs. So this helps management plan about operations and decide what to do. It applies to all kinds of businesses, right? So the starting point, though, is we have to understand something about business activity, right? What is the business activity that we're going to be able to base our decision making on? So when we're thinking about these activity levels, each company, each process, each product could have a different way of measuring activity levels, right? We could be in sales dollars, miles driven. If it's a dance studio, right? Maybe it's the number of dance classes taught, right? Lots of companies use similar things to this. And as they mentioned here, you really don't have to have just one measurement base, right? Different activities could have different bases that they are based on. So the changes in level, that's what we're interested in understanding, right? When the level of business changes, excuse me, when the level of business changes, how does that affect the total cost of the company? So we're going to be referring to something as activity level, and we're going to refer to that as either the activity index or the volume index. Essentially, what we're going to need to do is identify the activity that causes changes in the behavior of cost. Primarily, we're probably going to refer to this as sales. But as we mentioned before, certain kinds of businesses could have certain kinds of levels of output, right, that they measure. This will allow us then to classify our costs as variable, fixed, or mixed. So let's start with variable costs. These are costs that vary in total directly and proportionately with the changes in the activity level. So if the activity level increases by 10%, total variable costs increase by 10%. Now, I think it's important to understand this. What we're talking about here is the total variable cost, right? The variable cost per unit is the same. So for instance, if we're planning for next month's production and we make furniture, and each piece of furniture uses 30 board feet of lumber. What does 30 board feet of lumber cost? That's the cost for that production next month. And of course, you multiply by whatever the board feet is per unit. That gives you your cost per unit. If you make one unit, you know what the cost is. If you make 50 units, you multiply the cost of one unit by 50. So it's the only thing that really changes here is total variable cost. Now later in videos, we're going to talk about how do you analyze the things that are different at outcome, right? So we're predicting what's going to happen next month, the month after, etc. Of course, prices can change. So we're going to talk in a later video, we'll talk about how do we adjust for that, right? How do we plan for it? And then how do we make changes and reconcile what we thought was going to happen with what actually happens? And we'll talk about that in a lot more detail later on. So if you look at total variable costs, as it shows here, as you produce more units, the total cost increases. So at 2,000 units, it costs $20,000. At 10,000 units, it costs $100,000. So the total cost changes. But what doesn't change is the cost per unit, right? In this activity level, right, it is all $10 per unit. So the cost per unit is variable, and the variable here replies to the total cost, that the total costs reflect changes in the actual activity level. So total cost increases, variable cost per unit is the same. What about fixed cost? These are costs that remain the same in total, regardless of the changes in activity level. But what does change is the fixed cost per unit, because as you make more things, the fixed cost in total is divided by these additional units. So what example? We have property taxes, insurance, rents, depreciation. There's lots of fixed costs. The salaries of our factory workers might be included in here, etc. So what does this show us? The total cost, regardless of units, is the same. Now, this is only true within this activity index. So if we thought from 0 to 10,000, this is our fixed cost, maybe from 15 to 20,000 15 to 20,000 units, maybe we have to increase our fixed cost and increase our building size a little bit. So fixed cost would increase beyond that point. The cost per unit now, again, since we're dividing this lump sum by the number of things we produce, again, is going to show us this curvilinear function that shows that the cost per unit declines as we produce more and more things. So I think this is kind of confusing, right? Because we say fixed costs don't change. The total fixed cost does not change. But for pricing uses, right, to understand pricing, we have to assess some of this fixed cost to each individual item that we produce. So the per unit price changes, but the total fixed cost does not. So now it looks different from the other one, right? Here, total fixed cost is fixed, right? It's equal no matter how many units. But when you look at the per unit, again, we have a declining value in this per unit. So what we have to understand is that there are changes over time as we produce more or less material. So we have to understand or develop what they refer to as a relevant range. This is the range of production that you think you're going to be operating in, right? So we think we're going to be operating in the 0 to 10,000 unit range. That's where we think we're going to be. So then the relationship between variable costs and activity level, again, it's a curvilinear function, right? So we're going to have to understand that relationship in that range, right? For fixed cost, again, the relationship also, it's not linear, right? It's curvilinear, but there's going to be changes as the relevant range changes itself. So think graphically, we have a range. We think we're going to work between 40 and 80% activity level. What is our variable cost in that range? It's right here. It's this curve here. What is our relevant range and total fixed cost in this range? It's this line right here in this shaded curve area. So we have to understand what? We need to understand how to produce our products, but then we also need to understand the relative relationships in the range that we expect to be working in. Now, obviously, what happens if we exceed the activity level? Well, that just means our plan, our prediction, was off a little bit. So we need to revise our plan. We need to revise our pricing for that next potential relevant range. So all of these decisions are a revolving set of decisions. The same decisions made over and over and over again, because we're going to revise, we're going to review, analyze what has happened, and make adjustments so that we can ultimately optimize operations, so that we can optimize the cash flows of the company and the profits of the company. Now, one thing that's a little bit different is something called a mixed cost, right? So these are costs that have a variable element and a fixed element, right? So the change in total, right, but not proportionately with changes in activity, because it has this fixed piece. And the example I use for this is electricity. Think about a manufacturing plant. They work one shift a day. So they start at 8 o'clock and they end at 5 o'clock every day. So during that 9-hour window, they're producing product. So they're using lots of electricity. But after business hours, after 5 o'clock, they turn off everything, except for some of the stuff maybe has an internal memory, right? Sometimes they're going to keep some lights on. Maybe they're going to keep the fans running for the furnace, right? There are still costs of electricity when we're not producing products. So we need to be able to segment our utility bills into those parts that are fixed and those parts that are variable, right? That will help us, again, more accurately predict the total costs of operations. It will allow us to better understand the relationship between prices, costs, and ultimately profits. I look forward to seeing you in the next video. Take care.